Okay, so let's talk about VAT. It's a contentious subject, I guess. So what does it mean? VAT stands for value added tax, which is what it's known as in the UK. Most countries around the world operate some kind of a sales tax system. The US one is quite convoluted because it's state by state, but in the UK, currently 20% of the selling price is added on to inflate the price, and then that becomes payable to the government. And that's why it's a very different tax to things like income tax, corporation tax, and the other taxes that people may be familiar with. Most other taxes are a deduction from earnings. So, for example, your PAYE income tax, you get a salary, they take some of your salary, and it goes towards keeping the country moving. Same thing with corporation tax. It's based on the earnings made by the business in a given tax year, in a financial year, and they take a slice of those earnings and say, right, thanks, we're going to use that to pay for vital services and to line the pockets of, well, let's not get into that. So anyway, VAT is very different because it is essentially a tax that's added on. So you become a tax collector for all intents and purposes. So this is nothing to do, it doesn't matter how much profit you've made, it doesn't even matter how your business is doing, and it's not your money. At no point is it your money, and this is why HMRC are quite heavy in terms of chasing for VAT, penalties, interest, all the rest of it. They tend to go after VAT more aggressively than they do other types of tax because it's never your money. It shouldn't make any difference to your financial situation because it's not your money and it never has been. So yeah, you're effectively a tax collector for the government when you're VAT registered. Now, the principle is that the government take a percentage of, and in this case 20%, of any value added to any products by each stage of the supply chain that gets it to a consumer. So if you're a manufacturer, obviously you will then sell that to a distributor will sell it to a retailer, and then a retailer will sell it to eventually a consumer, a normal person in the street. Not always, not all products end up going to consumers at all, but that's an example of how it works. So in terms of how it works, let's look at a little example. So this is a pair of shoes. So we've got a manufacturer that makes shoes, and they've made a pair of shoes that are going to sell for £20. And they're selling that to a retailer. I've cut out the distributor in this example just for the sake of expediency. So this manufacturer has made a pair of shoes and they're selling them for £20 plus VAT to a retailer. The retailer has, in this case, added value by changing the colour of the shoes. Obviously, the definition of adding value is not yours, it's HMRC's, and you have to abide by it. So, for all intents and purposes, if you buy something with VAT on it and then sell it with VAT on it, you've added value. So, and actually, even more simply than that, if you've bought something for 20 quid and you're selling it for 35 quid, technically you've added value. So that's what's happening here. They've bought it for £20. They're selling it for £35 plus VAT to a consumer. So the total price to the consumer is £42. And this is where there's a clear distinction between B2B, as in business to business, and B2C, which is business to consumer. The key difference here is that a consumer cannot be VAT registered, so they can't claim back the VAT that they've paid. Before I go any further with that, I'm just going to talk about what I mean by claiming that back. Now, the principle here is that the government, or HMRC, should end up with 20%, or whatever the percentage is, but at the moment it's 20%. The government should end up with 20% of the value, the total value that's been added to this product. So the £4 that the manufacturer has added on to their product when they sold it to the consumer, that goes to HMRC at the point of sale. So when you sell that to when the manufacturer sells that to the retailer, £4 becomes payable to HMRC because it's £20 plus 20% VAT. So that needs to be paid over to HMRC. As soon as you invoice it, that liability is recognised. So when the retailer then sells that to the consumer, they have to pay 20%. They've added 20% to their to the £35 selling price. to make it £42. So they have to pay that £7 over to HMRC. So at the moment, HMRC have gained 11 quid here, and that's not correct, because the total value added to the shoes is not 20% of it anyway is not £11, right? So the total value of these shoes for HMRC's valuation purposes is £35. £35 times 20% is £7. Currently they've had £11. So what happens there is the retailer, when they complete their VAT return, can claim back the £4 that they paid to the manufacturer. So they don't actually pay the £7 over to HMRC. They put on the VAT return, they'll put the £7 in one box, the £4 in another box, and it deducts the £4 from the £7, and they have to pay £3 over to HMRC. So although my diagram shows £7 going to HMRC, it also shows £4 coming back from HMRC here. So the net amount paid to HMRC is actually £3 by the retailer. So the way that all pulls together is that HMRC need to end up with the 20% of the final value of these shoes. And when I say the final value, I mean the last link in the chain. Consumers are not VAT registered, so they can't sell that on and add the VAT on. If you sell second-hand shoes on eBay and you're not registered as a business seller, you're just an average person that has decided to sell an old pair of shoes, you don't add on VAT. You can't add on VAT. It's illegal for you to do that. So because of that, the last link in the chain, as far as HMRC are concerned, is the retailer. So once it gets to that point, whatever the value is, whatever the selling price is at that point, HMRC want to end up with 20% of that. So 20% of £35 is 7. So that's what they want to end up with. That's why they give the £4 back to the retailer. And the reason they give the £4 back to the retailer instead of refunding it to the manufacturer is because the retailer has not added all of the value to these shoes. So if we break it back again, go back to the beginning of the chain, these shoes at some point were worth nothing, right? So then once the manufacturer has manufactured them, they're worth £20. So the value added by the manufacturer is 20 quid. So the £4 that he's collected is his contribution to the £7. £20 times 20% is 4. So that goes to HMRC. Then the final value of these shoes when they're sold to the consumer, excluding the VAT, is £35. So 35 minus 20 is 15. That is the value that has been added by the retailer. Therefore, that is the element of VAT that the retailer is responsible for collecting on HMRC's behalf. So the £15 that they've added multiplied by 20% is 3. So that is what they ultimately should be paying over to HMRC. The reason it's done the way it's done is to make sure that everybody in the chain is contributing their element of value to HMRC. So hopefully that makes sense from this diagram. If it's still not clear, then obviously, as always, feel free to reach out to us. So that's how VAT works. It's a time-honoured system. It works well. It does make sure that everybody at each stage of the process is contributing the element of value that they've added to the product. In terms of when to register for VAT, because that's how it works, you have to be VAT registered in order to either collect, pay or claim VAT back or pay it over. So there's a threshold for that. If your business's turnover is £85,000 or more, well, at least at the moment, that is the threshold for VAT registration, for compulsory VAT registration. You can register voluntarily, but there's a good reason why you might want to do that. So what it really boils down to is the nature of your business and the product that you sell or service, if it's a service. So, for example, if you're a B2B business, which I mentioned earlier, B2B is business to business, so you're selling products or services to another business, then it almost certainly makes sense to become VAT registered, because in many cases your customers will also be VAT registered, which means that whatever you add on from a VAT point of view, they're going to claim it back anyway. So it doesn't come across to them like a price increase. It's just that's the selling price is whatever the selling price is, plus the VAT, which you're going to claim back anyway, so it makes no difference to you. And business to business, it makes sense to be registered, because not only do you have a free pass in terms of adding it all on, you can also claim back all the VAT paid on your expenses or purchases. Now, if you're a B2C business where you're selling to consumers, this is completely different. So if you're an e-commerce seller, for example, selling on Amazon, you can't add on the VAT. You can't quote a price to a consumer and then add VAT once they buy it. They'll just return it. That's not how it works. But either way, if you're a B2C business, let's say you're selling products on Amazon, you have to quote the price it costs, and you can still split it down by VAT, but it makes no difference to the customer, because they're not going to be able to claim it back anyway. But the point is, if you're selling to consumers, then the price is the price. Basically, you have to, as a B2C business, you have to absorb the VAT into your sales turnover. That makes it quite unattractive to register before you have to. So if you're a B2C business, I personally wouldn't recommend registering for VAT unless you cross that threshold of £85,000. Now the other thing to bear in mind is the product that you're selling. So if you sell, for example, if you run a cafe, a small cafe that does takeaway sandwiches, there's some clear distinctions between what should and shouldn't have VAT on it. If you run a cafe and people sit in and eat the food, then you've added value to it. If you just sell cold takeaway food, like sandwiches and stuff, then there's no value added. They take that, they go away, they eat it somewhere else. But anyway, the point is, if you sell anything, so those products inherently are either zero rated or exempt, depending which one you're talking about. If a product is zero rated, that means the same rules apply from a VAT point of view, but the rate of VAT applied is zero, so there's no VAT on it. If it's exempt from VAT, it means it's outside the scope of VAT completely. Now, for all intents and purposes, it's the same. There's no VAT added on. But when you're completing your VAT return, they need to be treated differently, so you need to be mindful of that. Make sure when you're entering stuff into Xero or QuickBooks or whatever accounting software you use, you just need to make sure you're getting the right VAT treatment in there. So yeah, that's pretty much it. That's VAT. Now, the only other thing to bear in mind with VAT is that it can lead to real cash flow problems if it's not managed properly. We've got a whole video on how to manage VAT because it is a minefield. People get more tied up with VAT than they do any other type of business tax, purely because it's not your money, but it's in your bank. And that is something that, it's human nature. There's money in your bank account, you're more tempted to spend it, or you're more likely to spend it, but this isn't yours. It's not like your corporation tax, where that is your money, that is your profit, but some of it has to go to the government. This was never your money, but it was in your bank account. And to be fair, I completely understand when you've got to choose between paying your employees or paying your VAT bill. Most people are going to choose to pay the employees, but it's a slippery slope, and I have seen people get into real problems with their VAT bills because the money comes into the bank account, they don't segregate it, and before you know it, it's got mixed in with all the other money, and then the VAT return, the quarterly VAT return comes around, they fill it in, submit it to HMRC, and they don't have the money to pay it because they've already spent it on something else. So we do have a couple of mechanisms on how to manage the VAT, the cash element of it, so check that out if you have problems, or you're concerned that you're going to have problems. But in terms of the mechanics of VAT, how it all works, what it's all about, that's pretty much it for this video.